DNO ASA is an oil, gas exploration and production company undergoing a strategic transition. Historically defined by its significant, high-risk operational footprint in the Kurdistan Region of Iraq (KRI), DNO has executed a portfolio de-risking strategy centered on the transformative acquisition of Sval Energi Group AS in the North Sea in June 2025. This pivot establishes DNO as a dual-pillar entity, an increasingly dominant, stable, and high-growth operator within the highly regulated OECD environment of the Norwegian Continental Shelf (NCS), supplemented by significant high-risk, high-return geopolitical optionality retained in the Middle East. The financial results from the third quarter of 2025, Q3 2025, provide conclusive validation of this strategy, showcasing record revenue of $547 million and an operating profit of $222 million, representing a doubling of key financial metrics compared to the preceding quarter. Total net production reached 115,396 barrels of oil equivalent per day (BOPED) in Q3 2025. This operational shift has driven a consensus rating of strong buy among tracked analysts. The average 12-month price target of NOK 18.5 implies a potential upside exceeding 21% from the current share price. The primary financial constraint remains the continuing geopolitical entanglement in the KRI, where DNO realizes significantly suppressed oil prices, currently in the low $30s per barrel for its contractor share. The resolution of this export crisis represents substantial latent value that is not currently reflected in the asset's depressed cash flow profile. Management's aggressive focus on debt reduction and enhanced shareholder returns, including a recently stepped-up dividend of NOK 0.375 per share, underpins the credibility of the new financial architecture post-acquisition. The investment thesis centers on capitalizing on the stability and organic growth of the NCS foundation while holding exposure to the high-impact recovery potential of the KRI assets. Corporate strategy and portfolio rebalancing. A. The transformative Sval Energi acquisition. The acquisition of Sval Energi Group AS, completed in June 2025 for $1.6 billion, was a decisive move engineered to introduce scale, diversification, and balance to the DNO portfolio. This strategic action successfully reversed the company's geographic dependence. Prior to the acquisition's full effect in Q1 2025, KRI dominated production, contributing 61,600 BOPED net compared to 19,300 BOPED net from the North Sea. By Q3 2025, the North Sea had become the primary engine, contributing 77,300 BOPED net, approximately 67% of the total net production of 115,396 BOPED. The acquired Sval assets instantly catapulted DNO into the ranks of the top 10 producers on the Norwegian Continental Shelf (NCS). The portfolio comprises over 30 North Sea fields. On a year-end 2024 pro forma basis, the acquisition quadrupled DNO's North Sea proven and probable 2P reserves to 189 million barrels of oil equivalent (MMB), with total contingent resources swelling to 316 MMB. This substantial resource base provides an estimated 15 years of production life at the current run rate, establishing a long-term, predictable revenue stream. Given the regulatory stability of the NCS, the large volume of contingent resources carries a lower commercialization risk than in frontier markets, providing DNO with a strong, organically replenished resource funnel for decades to come. Following the consolidation, Norway and the United Kingdom now represent nearly 60% of DNO's global production and about 45% of its global reserves, structurally de-risking the enterprise. B. Capital allocation and shareholder returns. Management has clearly articulated a pivot toward prioritizing cash value delivery to shareholders, coupled with stringent efforts to streamline expenditure and aggressively reduce debt. This commitment is formalized through the stepped-up dividend policy, with the board of directors authorizing a dividend payment of NOK 0.375 per share in Q3 2025, an increase from the preceding quarterly rate of NOK 0.3125. DNO is applying a strategy of high-grading its capital expenditure program. This is demonstrated by the decision to divest its 7.604% stake in the Ekofisk previously produced fields project in the Norwegian continental shelf. The rationale behind this move is the project's long lead time and significant capital requirements, with production not expected until 2029. Management seeks to deploy capital in ways that generate less spend and more barrels more quickly, favoring exploration and rapid-fire development of existing discoveries. Organic reserve replacement is a core component of this strategy, supported by a successful exploration record. The company achieved the play-opening Othello light oil discovery in 2024, Norway's second-largest find that year. This success continued into 2025 with the Kjøttkake, Mistral, and Vidsein discoveries, which collectively added a net 34 MMbo of recoverable resources. These exploration successes are vital for maintaining the 15-year reserve life in the North Sea, demonstrating that DNO can sustain its NCS production base organically. I. Operational performance and organic growth pipeline. A. North Sea organic growth engine. The North Sea portfolio, now DNO's primary focus, has a clear and executable organic growth trajectory. Post-Sval, projected North Sea production for the second half of 2025 is anticipated to be between 80,000 and 85,000 BOPED. Central to the medium-term growth profile are development tiebacks that utilize existing infrastructure, reducing both cost and time to market. The company has 6 ongoing tieback developments scheduled to come on stream between 2025 and 2029. These projects are forecast to contribute an aggregate of 25,000 BOPED net to DNO at the end of that period, representing nearly 50 million BO in proven and probable reserves net to the company. Recent production milestones further solidify this momentum, including the Maria Revit development, which began production in May 2025 and is expected to contribute some 4,000 BOPED net at peak. Other ongoing North Sea developments slated for 2026 to 2029 include Dvalin North, 10% interest, Simra, 20%, Besla, 39.3%, and Berling, 30%. The Verdande field, located in the Norne area, is already in advanced development and is scheduled to start production later in 2025. B. Kurdistan operations and production plans. Despite the strategic pivot, the KRI assets remain operationally significant due to their vast reserve base and low lifting costs. DNO's proven and probable 2P reserves in Kurdistan stood at 225 MMbo net at year-end 2024, remaining the largest reserve component globally, compared to 48 MMbo in the North Sea before the Sval acquisition. Production from the core Tauk license, including Tauk and Peshkabir fields, has demonstrated resilience in the face of ongoing export disruption, having recovered from the initial shock of the pipeline shutdown in March 2023. By Q3 2025, net production from KRI averaged 34,900 BOPED. DNO has managed to ramp up gross operated production on a test basis to 55,000 BOPED, split approximately evenly between the Tauk and Peshkabir fields, despite pending repairs and lingering security concerns following drone strikes. Looking ahead, management is pursuing an ambitious target of increasing gross operated production from Tauk and Peshkabir to 100,000 BOPD by the end of 2026. This volumetric growth is underpinned by a planned 8-well drilling program at Tauk in 2026. The success of this capital deployment program hinges not only on drilling performance, but crucially on securing adequate and reliable local monetization capacity, given the current uncertainties surrounding the Iraq-Turkey pipeline. Achieving the volume target without a corresponding resolution in pricing will result in capital expenditures generating oil sold at a deep, sustained discount, diminishing the returns on this significant investment. 4. Geopolitical risk and KRI financial overhang. A. The unresolved export crisis. The geopolitical risk in the KRI remains the single greatest headwind to DNO's total shareholder return potential. The operational shutdown of the ITP commenced in March 2023 following an arbitration ruling in favor of Iraq against Turkey. This closure curtailed approximately 470,000 barrels per day of oil exports and forced operators to divert production to storage or, subsequently, to local sales. DNO has continued to sell its contractor share of TOC license oil, currently averaging 30,000 barrels per day, into the local market at highly discounted prices, realizing a per-barrel price in the low USD 30s. This price realization imposes a continuous and substantial financial penalty. Assuming international benchmark prices, e.g. Brent, maintained a $50 per barrel premium above this realized local price, the foregone revenue stream for DNO's 30,000 barrels per day contractor share amounts to approximately USD 1.5 million every day. Over a standard 90-day quarter, this represents an opportunity cost exceeding USD 135 million. This substantial discount crystallizes the value trap dynamic associated with the KRI assets, where high operational efficiency is nullified by systemic political price suppression. B. Uncertainty in payment mechanisms and contract risk. In September 2025, DNO was instructed to prepare for oil export commencement through the ITP. However, DNO elected not to participate directly in the renewed export mechanism, choosing instead to continue cash and carry local sales in the low USD 30s. This preference for locally derived cash flow over the proposed export mechanism is warranted by the highly unfavorable initial terms of the tripartite agreement between the federal government of Iraq, the Kurdistan Regional Government, and the International Oil Companies, IOCs. The proposed payment for exported oil was set to begin at only USD $14 per barrel, after deduction of transportation costs, contingent on future adjustments based on consultant evaluations of commercial models. The underlying contract dispute concerns the financial entitlements under the production sharing contracts, PSCs, signed by IOCs with the KRG. The critical requirement for a long-term resolution is that the GOI provides assurance that any review process will encompass the full financial entitlements owed under existing contracts. The risk profile is further compounded by a history of payment arrears. Despite partial payments made in early 2021, DNO's outstanding balance related to withheld 2019 and 2020 invoices from the KRG still totaled USD 238.6 million. DNO explicitly cautions investors regarding the political risks inherent in operating within the KRI, including the uncertainty of the tax system and the risk of non-payment for oil produced. Therefore, although Kurdistan holds a vast reserve base of 225 MMBO net, these volumes must be assigned an imputed geopolitical discount rate in any valuation, acknowledging the high risk associated with their ultimate monetization at international prices. 5. Financial strength and capital structure. A. Q3 2025 financial performance breakdown. The Q3 2025 financial results underscore the immediate positive impact of the Sval acquisition and the associated NCS revenue stream, which accounted for approximately 92% of total revenue. Revenue surged by 191% year-on-year, reaching a record $547 million, and operating profit doubled quarter-on-quarter to $222 million. This nonlinear relationship between volume increase, 37% net production increase from Q1 to Q3 2025, and revenue growth, 191%, highlights the high-value gas component acquired with the Sval assets, which benefited significantly from prevailing North Sea gas pricing. The quarter also saw a dramatic stabilization in cash flow. Free cash flow, FCF, rebounded robustly to $101.0 million, reversing the temporary deficit of USD minus $110.7 million in Q2 2025, a quarter impacted by acquisition-related financing activities. Cash flow from operations nearly tripled during Q3 25 to $407 million. Earnings before interest, tax, depreciation, amortization, and exploration expenses, EBITDAX, reached $368.6 million. It is important to recognize the structural change in the cost profile. Lifting costs increased to $10.7 per barrel of oil equivalent in Q3 2025, up from $9.6 per BOE in Q2 25. This increase is expected to be permanent and reflects the geographic shift toward the North Sea, where operational expenditure, maintenance, regulatory compliance, and potential future carbon taxes, e.g. a hypothetical USD 50 per ton CO2e tax in KRI, could increase operational costs by $20 million annually, a risk relevant to all high-cost regions, are inherently higher than DNO's historical low-cost onshore KRI profile. B. Debt and liquidity management. The Sval acquisition increased DNO's leverage, with net debt standing at minus $808.3 million at the end of Q3 25. However, management has prioritized lowering the level and cost of debt. The debt-to-equity ratio, recorded at 94.1% as of September 2025, reflects an overall long-term reduction from 119.3% over the preceding 5 years. Debt servicing metrics remain healthy, with interest payments well covered by earnings before interest and tax at 4.8 times coverage and debt well covered by operating cash flow, 39.2% coverage. DNO has exhibited strong financial agility in refinancing and optimizing its capital structure following the acquisition. Key elements include the placement of a $600 million senior unsecured bond with an 8.5% coupon due in 2030. Furthermore, the company issued a $400 million subordinated hybrid bond with a 10.7% coupon, the proceeds of which are classified almost entirely as equity due to the instrument's specific structure allowing interest deferral and issuer option not to pay. This classification is a strategic maneuver to support the required minimum equity ratio of 30%. Crucially, DNO has secured significant non-covenant financing facilities, commencing with a US $500 million gas offtake and related financing facility with a major US bank. The company is actively finalizing similar structures for its North Sea oil and liquids production active January 1, 2026. These arrangements will bring total pre-financing facilities to over $900 million. By shifting away from traditional reserve-based lending facilities, $602.3 million of which were fully repaid in Q2 2025, DNO minimizes restrictive covenants, thereby maximizing financial flexibility to pursue its ambitious field development plans. V. Valuation and investor sentiment. A. Relative valuation metrics. The analysis of DNO's valuation metrics reflects the transitional nature of the company following the Sval acquisition, with near-term ratios showing volatility that is expected to normalize as the integrated earnings power materializes. DNO's latest 12 months, LTM, enterprise value to EBITDA, EV/EBITDA, stood at 5.4x in June 2025. This ratio is temporarily elevated compared to DNO's historical median of 1.9x over the 2020-2024 period. This high multiple is a common artifact of acquisition accounting, where the enterprise value increases immediately upon financing, while the full earnings, EBITDA, contribution only begins to accrue over subsequent quarters. Analysts anticipate a significant correction, with the 2026 forward EV/EBITDA consensus normalizing to 3.43x. Examining price multiples, DNO's price-to-sales (PS) ratio of 1.3x aligns perfectly with the European oil and gas industry average of 1.3x. However, this metric is notably higher than the peer group average of 0.7x. Conversely, the price-to-book (PB) ratio of 1.0x is slightly below the peer average of 1.3x. This divergence suggests a market view that assigns a premium to DNO's immediate revenue-generating capability, particularly in the high-priced North Sea gas market, yet harbors skepticism regarding the true value of the underlying tangible assets, likely due to the contingent and discounted nature of the KRI reserves. This indicates that the market is applying a discernible discount to the company's book value due to the inherent geopolitical risk retained in the portfolio. B. Analyst consensus and target price. Investor sentiment driven by the successful diversification remains strongly positive. The current analyst consensus rating for DNO is strong buy, based on projections from multiple analysts. The average 12-month price target is NOK 18.50, with a high estimate of NOK 20.0 and a low estimate of NOK 17.50. This average target represents a potential upside of 21.07% from the prevailing share price of NOK 15.28. The tight range of analyst agreement confirms confidence in the company's forward financial models post-Sval. Further confirmation of the portfolio de-risking is DNO's exceptionally low beta of 0.29. This metric suggests significantly lower price volatility compared to the overall market. The low beta reflects the market's recognition that the stable cash flow streams from the OECD-regulated North Sea are providing substantial insulation against general market turbulence, mitigating the historical volatility associated with DNO's heavy reliance on the geopolitically complex Middle East. This low volatility profile makes DNO an increasingly attractive component for institutional investors seeking stable exposure to the energy sector. 7. Investment conclusion. DNO ASA has executed a foundational transition, moving from a high-risk Kurdistan pure-play to a diversified hybrid E&P operator anchored by the stable, growth-oriented North Sea. The transformative Sval acquisition is already evidenced in the Q3 2025 record earnings and robust cash flow generation, establishing a clear path for organic growth in NCS production, anticipated to add 25,000 BOPD net by 2029. The management team has demonstrated financial dexterity by managing the post-acquisition debt burden through hybrid equity instruments and non-covenant offtake financing facilities exceeding USD 900 million. The valuation metrics, particularly the P/B ratio relative to peers, suggests an underlying undervaluation of the company's assets, largely driven by the heavily discounted pricing currently realized on KRI production. The stock offers a clear two-pronged pathway to superior returns: predictable high-margin organic growth from the North Sea core and significant immediate latent value unlock should a viable resolution to the KRI export and pricing crisis materialize. Critical monitoring points for investors are: KRI pricing and payment resolution. Analysts should track political progress in Iraq and the KRG regarding oil export contracts and pricing mechanisms. Any movement toward realizing Brent-linked prices for DNO's contractor share would eliminate the material daily revenue opportunity cost, estimated at USD 1.5 million per day, and necessitate an immediate re-rating of the stock. Debt reduction trajectory. While the debt is manageable, the maintenance of the net debt reduction focus, as articulated by management, is crucial. The successful utilization and refinancing of the current non-covenant facilities must be monitored to ensure the company preserves its financial flexibility. Unit cost management. Continued scrutiny of the rising unit lifting costs, USD 10.7 per bay in Q3 2025, is necessary to confirm that the structural shift to the North Sea operating environment does not erode the high operating margins generated by the high-value gas stream. Future European climate policy, including potential carbon taxes, requires proactive cost management.